Hello again, this is Nico. We're continuing a series on asset management. Um, Last time we took a quick look at the total structure of asset management, right? We had this kind of building shaped structure where we were mitigating risk, right? The higher up we went with our assets, the more risk we were having as we went up, right? And each each higher risk investment is built on the lower risk investments, right? And so we went all the way up from insurance to cash on hand, maybe 3 to 6 months cash on hand, savings plans where you got a mutual fund portfolio, um, maybe lump sums where you buy some specific stocks or bonds and hold them for a long term period, uh, real estate where you might build some passive income, startup investing where you're looking for that unicorn, but you want to build a portfolio of different startups, and then owning your own business or trading stocks on a daily basis or a monthly basis when trading something like that. These are all going to be built upon the lower risk activities below. And so today I want us to take a real quick look at insurance, right? Insurance is meant to protect us against a catastrophic loss. So I live in Italy, health insurance is covered. Don't have to worry about my health insurance. But in America, you want health insurance, right? Places like Japan, we've got national health insurance. Many places in the world we do. So that's not a problem. Car insurance, we need to have car insurance. In fact, many places it's the law. Without car insurance, you can get a big fine. Um, so there's that. It protects you against liability for something that goes wrong with your automobile. Well, then the other big piece of the financial picture is life insurance. Okay. Now, the first thing we need to understand is you don't need life insurance unless somebody is dependent upon your income. So if you're a bachelor, bachelorette, nobody needs your income to be replaced if you pass suddenly. You don't need life insurance. Don't let somebody try to sell you life insurance if you don't need it, right? Now, if you have a family, if you have children, if you have college expenses, if they depend on your salary for their livelihood, well, okay, maybe you want to consider getting some life insurance to help protect them. So let's take a look at. I just got an email from Fidelity Life. Let's take a look at what they have to offer. Okay, here's the offer I got in the email just shortly after that first video from Fidelity Life. They're offering term life insurance. Okay, there's typically two types of life insurance policies out there: term life or whole life or universal whole life, whatever you want to call it. But you know, when I was in America selling these products, licensed in life insurance with my 60, also licensed for mutual funds, I was always only selling term life insurance. It's a lot less expensive. It makes a lot more sense for people, no matter what your budget is. Thing is if we scroll down here, we can see, okay, you can get a lot of coverage, $1 million, right? $250,000 coverage, whatever. And here, a 30-year-old male is going to pay $16 a month. That's it for $250,000 coverage, right? If you want $500,000 coverage, $23 a month. And you're going to do this every month for 20 years or 15 years, however long your family is going to be dependent upon your income. After your children are done with college, if you plan it out, by this time my children should be done with college, that's how long I'm going to have a term life insurance policy. And then you stop paying and that's it. You're not covered anymore. If you survived it, congratulations, you're still alive. You were covered during that whole time against a catastrophic loss to your family. Right? but you don't get any money back, right? So the allure of the whole life insurance policy is that they're combining an investment product with life insurance, and you can borrow your own money that you put into the whole life insurance policy. You can borrow it back during your lifetime, and if you were to pass and that money hadn't been put back in, it would be reduced from your death benefit. But it's also variable. The death benefit can be variable, because if it's invested into a mutual fund based in portfolio, if the market goes down, it's the term life insurance policy is simple, straightforward. Here's the price for each, here's the premium each month, here's the number of years you're covered, here is the benefit. Finished. Whole life can be a lot more complicated. Ooh, you get the flexibility of being able to borrow money from the policy. And I was always telling my clients in America, buy term and invest the rest. If you were to take that same difference in the amount of money that you would spend on a whole life policy, you're not going to get a whole life policy for $26 a month, $23 a month. You're going to get a whole life policy for $300 a month. And so if you took the term life at, say, $50 a month, imagine it was $50 a month, and you have another $250 to invest on a monthly basis in a non-insurance linked mutual fund account, your returns are likely to be a lot higher, because those insurance companies eat away at your returns with big management fees as well. It's a poor investment. Never take whole life or universal life insurance policies, right? Let's take a quick look at what Investopia had to say about it, because you don't have to believe me. Okay, Investopedia, term life versus whole life, right? They're going to show you what the pros and cons are. So the pros of the term life, generally term life has a much lower cost than other types of life insurance. It's simpler to understand than permanent policies, whatever you want to call permanent. Then you've got the cons. Protections is only available for the term. Okay, once the term's up, you're not protected anymore. But the idea is that your wealth should be established through that asset management plan. Your wealth should be established to a point that nobody needs your income anymore. If you retired and you have enough wealth to live off of, then everybody has your wealth to live off of. You don't need to cover them anymore, right? It can't be used as a wealth building or tax planning strategy. Well, the whole life policy or the universal life policy isn't a good wealth building policy anyway, and there's 401ks for tax planning. You don't need to use those insurance programs. Whole life insurance, they're going to tell you the pros and cons. Pros and cons: with whole life insurance, you have the ability to borrow against the policy for future financial needs. Well, if I've invested the rest in my own account elsewhere, not attached to insurance, then I still get to take that money and I get a better rate of return. Loans, like death benefits, are generally tax-free. Okay, here, that's a point. If I was to cash out gains on my other account, I might have to pay taxes on those capital gains. But the payoff, I mean, I'd rather pay the taxes on my capital gains that year than, and probably not take them out, right? Then have to borrow against the insurance policy and not make as good of a rate of return. Right? I'd rather get the good rate of return up front and pay taxes on the back end, instead of get crippled by high management fees, never get the high rate of return, and not have to pay taxes on money I never made. Doesn't make sense. Other pro, you can lock in your premiums for life. Okay, yeah, I'm only going to pay $350 a month for the rest of my life. That's a big sum. $16 a month for the rest of the next 20 years. That's something I can deal with, even if I don't have a job for a while. Cons, whole life insurance policy is much pricier. Done. Finish. It's too expensive. 3, if you have to let the policy lapse within the first 3 years, you could face surrender charges. That's right. If you can't keep the policy up, you can lose money, and you can even have to pay money for closing the account. Any outstanding loans will reduce your death benefit. And again, if your portfolio within the product has lost money, the death benefit goes even further down. Point is, in the end, insurance is the basis of your asset management. You want insurance to cover you against catastrophic loss, to cover your family in case they lose you. Once you have that, you can start working on other assets. You can start saving cash. You can start saving cash anyway. You can start a savings plan, and you can have all these things going on with the ease of knowing that catastrophic losses are protected. Okay? So that's step number 1 in detail. Insurance. If you have a family, if you have dependents who need your income, get a term life insurance policy. The younger you are, the cheaper it is. So some places you can get a 30-year long-term policy. You can pay a year in advance or biannually. So you don't have to pay that $16 every single month. You can even pay off the whole thing up front. I wouldn't, because miss out on the interest income that you might make off of keeping that cash on hand. Anyway, just like it says at the very bottom, right? Choosing coverage can be tricky, but ultimately, the bottom line, whole life insurance policy offers more financial flexibility, but the old axiom, which I made a living off of, buy term and invest the rest. We'll see you next time when we'll talk about why we want to keep 3 to 6 months worth of cash on hand, and maybe we'll take a look at the basic savings plan again. See you. Bye-bye.